I'm Owen Bigland. This is the Inside Edge video blog. Okay, it's Saturday, so let's go do one of my investment blogs, the proper mindset you need for success in saving for retirement or living off your passive income, that kind of thing. So this one, we're going to channel the late, great godfather of index investing, John Bogle. I've talked about John Bogle many times, the owner, founder of Vanguard, one of the largest ETF companies out there. So, of course, I highly recommend reading some of his books. He's got a whole bunch of them. Or just go on to Google and search some of the writings of John Bogle. You know, he's a guy that keep it simple. Just index invest, buy the S&P 500, and call it a day. And he's absolutely right. He always points to the fact, I've told you guys this many times, that these professional money managers, these guys you see on Bloomberg and CNBC that manage money, you know, they talk a big talk like, hey, you know, put your money with me and I'll get you superior returns. And they're flat out lying to you. The facts don't substantiate it. Only about 10% of the active money managers every year beat the index, beat the S&P 500 or the VTI or the Triple Q. It's a futile game that they play, buying and selling, trading this, buying that, selling that, hedging this. It's all pretty much a waste of time, but they charge you for it. Exorbitant fees and trading commissions to outperform the index. So why not just buy the index? So here's some of John Bogle's famous quotes here. I'll just rattle them off here quick today. He says, don't look for the needle in the haystack, just buy the haystack. In other words, yeah, forget about picking individual stocks, buy the whole index, buy the S&P 500, buy the Triple Q, buy the VTI, or I tell you guys, one of my favorites is the VIG, the Vanguard Dividend Appreciation Fund. It's about 230 of the best American companies that not only pay a dividend, but have a long track record of increasing that dividend. Not going to go wrong with it. Time is your friend, impulse is your enemy. Yeah, don't do any knee-jerk reactions. Tune out the media, or if you do watch CNBC or Bloomberg, keep in mind that it is for entertainment purposes only. These guys that are telling you to buy this, sell that, I think the market's headed for a downturn, whatever. They have no clue what they're talking about. They're just taking guesses at it. Instead, buy the index, call it a day, and it will do everything you guys need. Where returns are concerned, time is your friend, but where costs are concerned, time is your enemy. Again, you know, when you're getting into these managed mutual funds that are charging you 1.5%, 2% MER or management expense ratio, you're paying through the nose to underperform. You have to look at what your costs are, which I'm going to get to in a minute. If you have trouble imagining a 20% loss in the stock market, then you shouldn't be in the stock market. Totally true. You know, look at what we're going through right now. S&P has had the worst first half since 1970. We're down about 25% on the S&P 500. TXS not quite as bad. This is par for the course. As a matter of fact, you should look at these corrections as good buying windows to buy more shares, lock in better yields, and buy the dip. You have to expect this. Have a look at the 30, 40, 50-year chart on the S&P 500. You know, it's not a straight line up. There's going to be some good years in there where it spikes up. There's going to be some bad years where it's down 10, 15%. There's going to be some years where it treads water. That's par for the course. If you want the superior returns, you're going to have some good years and bad years. Take the bad years and try and put a little extra money in during those downturns. Fund investors are confident they can easily select superior fund managers. They are wrong. So you're right. Forget about trying to pick these managed mutual fund managers. They're all pretty much the same. You might get lucky and be one of the 10 or 15% of the funds that eke out a small return higher than what the indexes are. But you know, they can never do it consistently. You have to remember that. They might do it for a year, or maybe they get lucky for another year, but they're not going to do it for 10, 15, 20 years consistently. It can't happen. Finally, you know, the mutual fund industry has been built in a sense on witchcraft. So as you can see, John Bogle is not a fan of getting your money through money managers or paying these fees for these active managers. So, I had a guy just recently, he had called me to he was thinking about buying about a $2.5 million two-bedroom condo in Cole Harbour. And he was currently renting, had a decent rent, although he was on borrowed time. He thought that the owner of this unit was probably going to be selling it in the next year or so. So he was thinking about buying, and I said, for sure, once you're ready and you're committed to home ownership, yeah, I agree. I'd stop renting and buy. This guy had a good job, earning well into six figures, quite a bit above that, actually. We got talking a little bit about stocks. He was with one of the big Canadian banks and had a pretty substantial portfolio, north of $4 million, he told me. And he had some good companies in there. He had the Apples and Amazons and some good blue chip names, some Canadian banks and BCE. It seemed like a pretty well diversified portfolio, but he also told me that he was paying pretty close to 1% annualized management fee. I think it was 85 basis points. So that's substantial on a $4 or $5 million portfolio. I mean, he was paying over $40,000 a year for this guy to manage his portfolio. And I said, how is your portfolio done versus the indexes? And he didn't know. And that's pretty typical. These money managers that are managing your money and charging you 1% under management, they generally don't want you to know how the portfolio they're managing for you does against the S&P 500 or the TSX or the Triple Q. The reason they don't, and the reason why a lot of these guys that come on Bloomberg and CNBC, you notice how they never reveal what their 1, 5, 10, 15-year returns are on their managed portfolio and how that compares to the indexes. The reason they don't want to reveal that is because they're lagging behind the indexes. And that's one thing. But the killer or the kick to the head is that they're charging you, this particular guy, over $40,000 a year, plus trading fees and everything else for the privilege of underperforming the index. So, he's a prime guy. I didn't want to get too involved with it, but I said, that's a lot of money you're paying. You may want to just spend the 100 hours, like I often tell people, buy a few books, go to a site like Canadian Couch Potato, and just buy a simple, balanced ETF portfolio. They've got all their model portfolios there, and instead of paying $45,000, you're going to cut that down to probably about $3,000. And the final kicker is that basket of ETFs, the model portfolio at Canadian Couch Potato, over the next 10 or 15 years will probably outperform what this big bank guy is doing for you. So something to think about. And that's what Jack Bogle has always preached with his books, and the whole reason why he founded Vanguard, to provide low-cost index investing that will do the job for what most people are going to need. You'll outperform the managed funds at a fraction of the cost. So I'm Owen Bigland. Thanks again for everyone that's been buying my books still on Amazon. Thanks to all my new subscribers on YouTube. I'll see you guys next week.